Okay, so welcome back, guys. I know it's been long since I last recorded a video, but luckily I'm back to my feet. I can now record. So I have some good news. We're going to be live trading by the third week of November. I'll be in the markets because I'll be done with what I'm up to right now. I think so. May Allah enable us. And I want to talk about what has been going on when I wasn't around, what I didn't get a chance to talk to you about. So, in front of you, having the Nasdaq E-mini futures chart. This is not real-time data. This is a delayed chart, but that doesn't matter. It's a weekend. So this is now the current data. So fine, it's delayed, but it's the weekend, so it doesn't matter. It's not playing real time. Today is a Saturday. The market has been fucking traders seriously the past days. I've been watching traders getting smashed like, I don't know, like hell, complaining that the market is only rewarding 1 hour trades or shit of that sort. But come to enlighten on what has been going on for the past days. So this is the daily chart. I want to pull your eyes onto this move right here. This large range candle is what we call a liquidity void. That candle disrupted a lot of traders in their trading. So most of them thought that NAS had started crashing down, going into some liquidity pull down here, but the market ended up just dropping that and then leaving it like it didn't happen, then rallying higher. But there are reasons to this rally higher, and basing on this very candle that traders thought was going to continue lower. So a liquidity void, most of the times I'm looking at, if I'm having these large range candles on the higher time frame, I'm looking at the equilibrium price of them. So if I'm to put that onto the chart, put some source onto the chart, so there you have equilibrium. You are having equilibrium at 24770 and 3/4. So that is the equilibrium of the liquidity void. Now what do you see? What do you see happening at the 50% of that? If I'm to lock that into place, I don't want disturbances. So what do you see at that? Most of these moves on the daily are speculated going in consideration with the 0.5. So we have Monday opening up, rallying higher, and for the past weeks the market has been following the weekly profile really well. So we have Monday rallying higher, leaving no bottom week. This is sell side liquidity. Tuesday drops, gives us the low of that week. Wednesday rallies higher, Thursday rallies higher. Friday smashes into Tuesday's low, taking out the liquidity at that. We are rejecting into from this candle's closure to this candle's open. This is the new weekly opening gap. We are rejecting in that. So this is that would be your new weekly opening gap, just like that. So as you can see, the market is rejecting in that and then pushing higher. Now I want to talk about something so simple about rejection blocks. So what is the confirmation for a rejection block? Now there is no way you're going to find this, but I'm going to say it. When do you know that a wick is going to fail or it's going to hold the market? I bet you have not heard of that anywhere, but to know that a wick is going to hold the market, first and foremost, it depends on the direction I want the market to go to. If I'm wanting the market to go lower, I need a confirmation with a bearish closure on that rejection block or that wick. So I want a week that closes bearish if I am going to go lower, and vice versa. If I'm expecting a certain week to push price higher, a week in price, not a week as in time, a week, this and that. If I'm expecting for a week to give me higher prices, I'm expecting that candle with the wick to close bullish, and for it to give me lower prices, I'm expecting that candle to close bearish. So what's the indicator in price? The closures, not the closures. So that is the secret sauce behind rejection blocks. Not that every week that rejects is a rejection block. I wish you feel me. So looking into this, I'm having this candle having a wick that took out that. The market drops into that. This is fine for a rejection block. The market dropping lower as long as we do not close below it. This is respect to this in a form of a liquidity sweep. Then we rally higher from that. A drop into this other block, we reject that. This is not what I'm considering as my rejection block. I'm expecting the market to push price higher, so I'm expecting a candle with a bullish closure, which is this, to act as my rejection block. That gives you that entry right there, going higher. I hope you understand. So why do I expect this Tuesday's low not to be protected? This Tuesday closes as a bearish candle, so by all means, I'm expecting this to be raided. If the market happens to come back into it, trading into deep levels of that week, I expect the market to fail that, sweep it, and then rally to whatever direction it wants to go to. So we have the market dropping and taking out that. If I am to annotate it for you on the chart, remember this is a daily time frame, so the liquidity sweeps might not be that big, but they mean a lot. So this is, if I'm going to say this as minor by minor outside, I'm going to tap that as keeping that as Tuesday's low, so side liquidity. So I think I'm done with this. I just drew this just to talk about the rejection blocks, the confirmations. Okay, we take out that and note where Thursday's high is. Thursday's high is right there. In situational analysis, according to my situational analysis, I'm having the situational analysis as this. If Wednesday's high is not as high as Monday's high, then I expect the low of Wednesday to be taken out. Is that clear? And if Friday's high is not as high as Thursday's high, I expect the lows that were formed on Friday to be traded to be referred to by the market. I hope I'm clear about that. Okay, so I want you to listen to that carefully. And I'm having Friday not being as high as Thursday's high, but I expected Tuesday's low to be protected, and it wasn't. So this can be also violated. I'm having a bullish fair value gap we are reacting from right there. I'm having a new day opening gap, so I do not. This is a rejection block. Swoop this low, reject back higher and close bullish, but the market coming back into that is not my end, is not so much expected, because I'm having a new day opening gap right there between Thursday and Friday. We have a volume imbalance on the daily right there. This is a new weekly opening gap, this being a bullish week. So we have Monday trading higher, inversing this. This inversion stipulates a move to go higher. From to put an inversion fair value gap just there. So this is the inversion fair value gap I'm talking about. Monday rallies higher, closes above that. This shows an intention of going higher. So Tuesday drops, takes out Monday's high, drops. So that's a situational analysis. Tuesday takes out either of Monday's liquidity. So in this case, we take out buy side, then we drop lower. When is the low of the week expected to form? I've been teaching this throughout my videos. The low of the week is expected to form between Tuesday London session going into Wednesday New York session in the PM hours. So between Tuesday and Wednesday, if the low is not formed on Tuesday, so I'm expecting it on Wednesday. Wednesday drops, takes out Monday's low. That means it crossed Sunday's open, and Sunday's open happens to align with consequent encroachment of this inversion fair value gap. Then the low of the week is formed on Wednesday, tapping into this new day opening gap, rallying higher. So I'm having an order block. We'll rally higher. So going into this Friday, just pushes higher, going above. This was all-time highs back then. Now, if I'm to measure where did this move start from, I'm having this as the origin of the move. So if I'm to take this that way, measuring from this low to this high and getting standard deviations of that, or expansions of that. So if I'm to measure just like that and drop expansions on that, you happen to see that we are having the -1 and the -1.5 going into the 2 and the -2.5. So expect the market to work into -1 and -1.5. So this is expected mostly half of that range. So between the -1.5 and -1 standard deviations, I expect the market to respect or to go to half of that for sure. Then the market happens to render and give in more than what we expected of it. So I won't be surprised if the market continues from where we are at right now and continues higher, attacking the 2 and the -2.5 standard deviations. Okay, so we're having a large range new weekly opening gap right there. So I'm looking at that as a draw liquidity. Up above, I'm having this new day opening gap and this new day opening gap plus that. Okay, so going back into what I said about rejection blocks, why are we having this Friday dropping lower? I'm having where we are at right now. This is -1.5. I have said the market has rallied higher than what we expected. So this is when I expect the market to put in an intermediate term high, at least to balance this price movement. So if this is a short-term high, So if that is a short-term high right there, I think I won't use this. I'm going to use this. If that is a short-term high, and this is a short-term high right there. Oh fuck. Sorry for cussing. But hey, these things are annoying. And you happen to find out that there are more than I was going to crash out. So I'm having 3 dots right there, so I'm going to make this probably red. So I'm having 1, 2, and 3. So this is the red one is my intermediate term high. I'm having a short term high and a short term high. So not looking at this, so this hasn't formed. I'm having this high. Okay, trellis on Thursday and takes out Wednesday's high. So for me to form an intermediate term high, so this high should be protected. And just note how this candle closed. It closed bearish with a long wick, rejecting that candle's high after taking it out. So within this rejection block, I'm fit to call this a rejection block. Let me just put off this. Within that rejection block, this, I can look for an entry going low. Now I want you to note consequent encroachment of that. So that's what I'm having right now. Note consequent encroachment of that. It gets toggled right there, rally into consequent encroachment of that, and then we drop lower. What am I looking for? What am I looking for? Having this as the weekly range from that low to that high. So from that high going into that low for a TGIF. Sorry. Okay, so on Friday I'm expecting these levels, market to trade to 20% of the weekly range, 30%, 40% of the weekly range. But this is a bearish week. If we are to go higher, this had to close bullish. But it's a bearish week, so I expect this to fail at any point in time. Okay, putting that off and this off, I want us to having the liquidity void right there. So dropping into the 1 minute, I want us to talk about today's trading. So today's trading was a fun one. I'm kinda tired a little bit tired a little bit. So looking at this one-sided price action right there, we're having this long wick coming back into this breaker. So I'm expecting something within that. Now going into a higher time frame where that will be scaled into 1. having this 1 hour large range candle. So the whole of this is a liquidity void, as I just explained to you. So I'm going to put in quadrants on that. Not want this to be extended, right? Okay, so that's what I'm having on the 15-minute. Knowing that I'm having a liquidity void the market hasn't traded into, so I'm expecting sales on a Friday. I already showed you the rejection block. Expecting sales when I'm having a liquidity void. Expecting the market to trade to 50% of that at most. And if we happen to be more bearish, going into the lower quadrant of that, what do we have at the lower quadrant? Sell side liquidity as this low. Okay, so my bias is set. I'm looking for sales. If I'm to look for sales going into this, it's funny how I managed to take a trade at that. So I participated in this trade because I only managed to have that because I was in the market prior to the session. So I'm having this sideways market movement. So this is accumulation. If I am to mark the whole of this as accumulation, from that high to that low, considering the whole of this as my accumulation phase, I'm going to mark that green. Remember, for a bearish day, I'm looking for this market to accumulate, then manipulate in the direction in which I'm not going to give me a Judas swing for a move lower. So I'm having my accumulation at that. So a manipulation above this is my Judas swing. So from the moment we break out of that, breakout traders are going to enter longs, and when they enter longs, the market is going to satisfy that with a false move going higher. For the first false move going higher, the traders are going to be trapped into that loophole of buying, because fine, we have liquidity on both sides, but traders are going to be caught up in that loophole of only buying the market, yet it's a Judas swing. And as I told you, a Judas swing is like a slaughterhouse for sheep. So whenever you're caught up in the slaughterhouse, that's bad news for you. Okay, so we rally above that, we manipulate, this being my Judas swing. That being my Judas swing. manipulate above that. Okay, so I'm having my accumulation, my manipulation. So this confirms a move for me going lower. So I'm not looking for any higher prices. Now, where is my 7 a.m.? So 7 a.m. opens up right there. If we are to go deeper into further analysis, having this manipulation move, where does it go to? I'm having a balanced price range. We delivered buy side, this candle dropped and delivered sell side. So I'm having that as a BPR, a balanced price range. So I know that range is balanced. Extending that further into price, this holds the market right there, give us a push higher, going above buy side liquidity, and then giving us our Judas swing. So 9:30 opens up. I want to trade only at the opening bell. 9:30. What am I missing on my chart? I'm missing my 12 to 12:30 opening range, still for my bears. So for these markets, this is an area you can't go wrong if you know the direction of the market. This is you trying to get the overall direction of the market for that stipulated day. Okay, so I'm having that as the high, and then that as the low. So if I'm to zoom in, see whether I got that correct. So now this in a form of a market maker model, having the market manipulating, considering this as my original consolidation. So 9:30 happens to be originating from the 12 to 12:30 a.m. opening range. Now that is a sigh of relief for me, knowing that we are not supposed to come back above or go into that 12:30 to 12 a.m. opening range. So I know that has been filled. We are working from that. The top of that gives us this accumulation, and 9:30 opens up dropping lower into that. This failed. Then after that, next candle drops and closes below the BPR, having a bullish order block right there. So this is my bullish order block. So sorry, my bearish order block. What am I saying? I'm so tired. This is a bearish order block. Now this, the high of that candle, I'm expecting that to stay untouched. I don't expect the market to trade above it if we are to still go lower. So this is my safety line. So my first entry is at the top of this. I don't need this. My first entry is at this top of that order block. Second entry at the BPR. Then we managed to drop lower aggressively. This is the needle opening gap. Market drops and closes below that, references into that one more time. Now this move that failed to form a higher high with this high, this is my mitigation block. So I'm having this as a mitigation block right there. So this is a mitigation block. Okay, because it failed from a higher high, and when it will drop and close below that, this candle's body crosses that line, and then we retest into that. So I'm expecting this to stay open, the high of that candle, and from this candle to that candle, market uses that, and they need the opening up to push price lower. Pushing price lower into what? So if I'm to highlight that, okay, that blue line is the upper quadrant of the liquidity void we had marked on the 1 hour time frame. So the market drops. If you manage to hop into this at the BPR as the entries I had stated, so if it's something of this sort, this is the top of the order block, so expecting lower prices into half of that. Into half of that, the market drops into the upper quadrant, so collecting partials for every time it hits that. With that once, you take off, come back close to it for the second time, you take off, then this drop lower into that, you take off, leaving a runner. Okay, so you have backed out most of the position. Now you are fine with the market reversing or going where it in whatever direction it wants to go to. So we drop. What are we dropping from? I'm having this volume imbalance, but this volume imbalance and this volume imbalance, this is a suspension block. So if I'm having two volume imbalances within one candle, that is a suspension block right there. Okay, so I'm having my suspension block, I'm having this candle rallying higher and tapping my suspension block, leaving me a bearish wick. So I'm expecting that to hold the market. I'm expecting this to work as a rejection block. That as my rejection block, and as you can see, it rejects the market all together with this suspension block, push price lower into the upper quadrant of that, and again, then rally higher and take out the suspension block going into 10:30. So there was an orange folder news at 10:30. So rally higher, we failed to take out the OB, and then we just ride. Now this is the proper example of a mitigation block. I'm having a high and I'm having this high. If this high managed to go and cross above that, I would be looking for a breaker. But if that high fails to close above this high, this is a mitigation block. Now what is the use of a mitigation block? A mitigation block enables, so suppose we are in a sell trend, enables those who went long to recover and go to the right side of the market. That is a mitigation block. So this candle's law that stipulated this high, so we have that fail and that. So if this took out that and then brought up a move going higher, this would be the mitigation block. But this is where it all started from. So having this as my mitigation block, okay, so I'm expecting that to work as my mitigation block. that would be if you took out at this and put your stop loss at break even right there, then this would be an entry. Within this mitigation block, my stop loss is above that the last bearish candle. So I expect that not to get traded past. Now having the market respecting that really good, then we drop lower. Okay, we continue dropping lower. I think I won't be doing like top down analysis about this, but I think I'll have to do that later in the day. But yeah, so that's how the wholesale move came about for Friday. I hope you found this insightful. I don't want this video to be long. So if you found it insightful, thank you for listening.